from Robertson Morrow. Jason is a chartered accountant, a self-managed super fund specialist and tax agent with degrees in both law, Honours Class 1, and commerce from the University of New England, where he has also tutored and lectured in a number of subjects, including taxation law. With more than 22 years practical experience, the last 14 as a partner of Robertson Morrow, Jason takes a holistic approach towards achieving client goals, understanding that the optimal entity structure can change over time. Jason works closely with his clients to develop commercially astute opportunities and grow business to their full potential. So in a second, I'll throw to Jason, and we've been having a little bit of fun with technology. So unfortunately, Jason's camera is not working, but Jason, let's see if we can successfully flick to the screen share when you're ready. Are you there, Jason?
Yeah, has that come up, Alison? There we go.
Not yet. Oh, this is looking promising. There we go. We're good.
Okay, so everyone can just see the first cover slide?
I sure can. So I'm just going to assume that everyone else can as well.
Yes, can see it.
Great.
Wonderful. Great. Okay, Alison, thank you for that introduction. And apologies to all that I don't have my camera working. That is one of the frustrations with some of the using technology for these sort of presentations, but we do have some slides, and at each slide, as Alison's already mentioned, I'm more than happy to take questions. In fact, the best outcomes, I think, from these sort of sessions are where it's quite a Q&A type scenario. So, so please just unmute and we'll just go through any questions as we go. So the focus of the presentation is around early stage investment and the different financing options that a founder will be faced as the technology or the project is undertaken, and there's a need to garner further support and in particular financial support. Now, that should click through. So please, there's the usual disclaimers as you'd expect on this sort of thing. It's very general in nature. And I'm clicking again. Okay, so first up, I think we'd all know in this environment and with the group at hand that for R&D tax incentive, you need to have a company set up. So that's one of the key criteria. When you set a company up, how many shares, who should be the shareholder, the capital. Now, the start point with a company is it's all these things are your decision, and the thing that we would always advise at the start is to maximize the flexibility that you would give yourself going forward. Now, when I say flexibility, that's both in regard to the number of shares you might initially issue and any capital you would provide to the company. So a typical, what used to be called years ago, mum and dad company would be a 2-shareholder company, 1 share each, 2 directors, and commonly secretary and public officer and those sort of positions as well. Now, the start point here is to consider what the future might hold and getting the structure right at the start. Our go-to usual way of setting up a company, unless there are other circumstances, would be to have a discussion around the use of a family trust as shareholder. So the upside of that is if you start off with a family trust, you garner the flexibility in the future that should there be a successful outcome on a project, whether that be a capital sale in the future and or commercial undertaking generating profit, the owner of the shares is a discretionary trust that you as the individual would control as the trustee, and within your family group, any benefits that come from the undertaking you've had can be dispersed with spouse, kids, parents, even out to siblings, essentially within your family group. So it gives you quite a bit of flexibility in the future to disperse those proceeds of any business sale and or profits from an undertaking. The setup of a family trust is often a matter of, well, what's the additional costs? A trust deed in a typical setup is a matter of some hundreds of dollars, $300, $350, if that's through what we would call a deed provider or a document provider. One of the things here that you would give consideration to is where that trust is established. If it is in New South Wales, there is unfortunately some additional stamp duty, being $500 to establish a trust in New South Wales. If you were to do it in, say, Queensland, there are no stamp duty costs on top. So it really is just the document cost. So that maximises flexibility. You then might, with a view again to ensuring great flexibility going forward, how many shares might you issue? Now, that old number of a $2 company means that should there be reason for you to consider bringing in part owners, it's very difficult to split 2 shares amongst 5 people, for example. So at the start, what you might consider is, and one of the tricks of the trade is, if you think about 120 shares or 1,200 shares, depending on how many you would like to start with and the amount of capital, 120 is divisible by 6, 5, 4, 3 and 2. So it makes it quite easy at some juncture to actually split the existing shareholding between multiple people and have that a fairly even number to manage. The type of shares can be considered up front. Initially, you would normally have what's just called ordinary shares. So those are ones that have rights and capital rights. So just what your atypical what you would see in a company. But there are other types of shares. There's many others, like preference shares. In the initial phase, keeping maximum flexibility, unless there was other reasons, you would typically just set up ordinary shares with equal rights between them and keep moving. You would, at that stage, right at the beginning, consider the initial directors and look at individual responsibility, what that comes with. So directors do have the protection of limited liability from a company, but you are responsible as individuals for ensuring that the company meets its obligations, such as superannuation, pay-as-you-go withholding, and that can be a personal liability should those obligations not be met. Liability is limited then above those things to the assets of the company, so it does provide good protection as individuals. So before I move on to another slide, I just wanted to open up if there are any questions regarding that initial setup and any other thoughts or considerations anyone in the group has.
Jason, I'll kick off with a question just to get things rolling.
Sure.
You talk about the stamp duty being that there is a stamp duty cost if you were to set up a trust in New South Wales as opposed to Queensland. Do you have to be a resident of Queensland to set up to base your trust?
No, good question. So there are document providers, and you could imagine there's a lot in the industry. If you are happy for them to take on what's called a limited power of attorney, only to execute. So that is the sole purpose of that limited power. Those solicitors in Queensland can establish the trust, and that is the jurisdiction for stamping. So it is quite easy to establish a trust, not in New South Wales, if you would like to go down that path.
Thank you. And Jason, we've got a question in the chat box. Can you see that, or would you like me to read that one out?
Sorry, I can't see that, Alison.
That's right, I'll read it out. This is,
if you wouldn't mind.
Is it possible to start as a sole trader, but once you get investment opportunities, to switch it into a proprietary limited company with, say, 1,200 shares?
The short answer is yes. Looking at that question from an R&D perspective, you cannot be an individual and register for research and development tax concession and make a claim. You have to be a company, but an individual or a partnership can use various provisions within the Tax Act to essentially roll over the business activity into a company without triggering or with a rollover of any capital gains. So yes, you could, in a normal business environment, start off as a individual sole trader or a partnership before going to a company.
Sorry, Jason, can I just ask a question? What's the R&D tax incentive? What is it?
So that's a government scheme that is really focused on startups who have an original piece of intellectual property, so an idea as to a new way of doing something or a new, just new technology, and essentially that and this is a very, very broad summary, but if you are registered with that original idea and it's an idea that is accepted by Oz industry, so you become registered in the scheme and you spend more than $20,000 in any given financial year on eligible research and development costs, then there is a tax offset, a refundable tax offset, should your company not be profitable, that the government pays back to you to basically incentivize you to continue to develop whatever technology you're trying to develop.
Okay, thank you.
If there's no other questions, so I'll just move on. So the key focus of this session is the establishment, the early start off of an entity, and in particular funding and financing. Now, at a very high level, what we're really talking about is bringing in finance on either an equity or debt basis. Very broadly, they're the two sides of the coin. Now, between equity and debt, there are a myriad of things that sit between those two poles that might have some debt characteristics and some equity characteristics. It's on a continuum, so to speak. Now, there are different pros and cons to looking at financing via equity versus debt, and I'll roughly go through those. In the first instance, equity financing is a function of, okay, you're looking at selling some of the ownership interest in the company. The first issue, of course, is to strike a price. Now, value is always in the eye of the beholder, particularly in an early stage investment entity where you might have something that's very early days in its commercial development. There might not be any profit history. you're looking at striking a price based on what an investor, an equity investor, is bringing to the table. So that is a negotiation at that juncture that's not so much about the value of the inherent idea and the value of any cash flows it may in the future generate, because that is extremely hard to quantify. It is often more a discussion around the value that the equity investor would bring. So if they're just bringing finance, then that's fairly easy to quantify. If they're bringing finance plus expertise and knowledge in a industry or type of business venture that you're trying to get off the ground, then that's another thing entirely. And those sort of discussions really go to striking a price in that negotiation as to how much of your equity are you prepared to give away to bring that individual in. The key thing that often gets forgotten in those negotiations and striking that price is it's often in an early stage investment just the kickoff point. So you bring somebody in, but not too far down the track there is a need again to raise further funds. There's perhaps you're still developing the idea, or perhaps you're testing it, or perhaps you're looking to now commercialize it. Whatever the business venture is you're undertaking, but to take it to the next level, more funding is needed. So you have to start thinking about in that first instance, well, if we bring some equity in now, what does that mean for any future either equity or debt financing that we might look at? Very important to have those thoughts up front and really have some clarity, because once you are in business with someone else, another equity partner, you both need to agree as to that future direction. So there's really two ways. There's sale of existing shares. So as I said, if you've taken the opportunity at the outset to, let's say, set up with 120 shares, you could sell a quarter of those shares, a third of those shares, half of them, and bringing someone in on a percentage basis like that. The issue there, and there's two ways of bringing equity in, and the first one is to sell these existing shares. But if you've set the company up and the shares start off as $1 each, it's just a startup investment, any value or the price you strike with that investor, if you end up selling those shares for $5 a share or $10 a share, you immediately have capital gains tax consequences to consider. So you as the shareholder are disposing of part of your interest. You're actually the recipient of the cash. So in that instance, it's not the business that receives the cash to facilitate its growth. It's actually in your back pocket. And from there, part of this transaction would be an agreement from you to put that money back into the company for the growth. So to give you a very quick and rough example, if you were looking to have $100,000 of funding come into the company, you might say to somebody, okay, look, I'd like to sell $50,000 worth of shares. They buy $50,000 worth of shares off you. You then both agree, okay, the share is now 50-50. We will now loan in $50,000 each, the 50 I've just received from you from the disposal of my shares, and the new investor loans in the second $50,000 to maintain maximum flexibility. So in that scenario, you still have a modest amount of share capital, perhaps 120 shares, and you've got at-call loans that those two investors have now put in together. So that's the first scenario. That is, in this example, actually not the most common scenario for equity investment. I think at that juncture, I might go straight to the next slide before taking questions, because the next slide will probably answer some of them. In regard to equity investment, what is more common is for you to look at issuing new shares in the company. So you would have your existing capital from the startup. You have a need for finance. You would seek and have negotiations with someone who is interested in becoming an equity investor, and you would be looking to issue new shares in the company. Now, if they're fully paid shares, they would have the same rights to dividends, capital, and voting that you would have on the original ordinary shares. It's common in some scenarios to look at bringing in an investor on a partly paid ordinary share basis. Now, the reason for that is they might not want to put $100,000 in one go and have that sitting in the bank account to be used piecemeal by the business over time. So they might buy $100,000 worth of shares, but partly paid shares, where initially they put in $20,000, and then when the business needs it, there's a call on their capital and they put in another 20 and another 20 and so on. So that's a way of staggering out that person's contribution to tie up to the business financial needs. And the third way of issuing equity, and it's not ordinary shares, would be what we call, and there are various types of these, but I'm just broadly summarising these. Preference shares have characters of ordinary shares, being equity, but they also have and can be the situation, they have debt characteristics as well. So they will often see, not always, but they'll often have a set dividend or interest rate. If in a year that interest can't be paid, given the financial position of the company, then the interest accumulates and gets paid when there is monies that are available. Preference shares will often have priority for payment of dividends and interest over ordinary shares. So a preference shareholder is getting more security in the future than an ordinary shareholder. Again, they would have capital priority if everything ended up being wound up. The preference shareholders would receive their money back first. They can be redeemable, where, okay, I would like to bring you in as a shareholder. We'll do it on this basis at $1, but there is a written agreement that they could be redeemed for some other amount, perhaps $1, but perhaps $2 or $3 within X number of years. And that those terms are set up front. Or they might be convertible to ordinary shares on a certain date or for a certain price. So preference shares are a mechanism where somebody, particularly the investor, wants a little bit more security than an ordinary shareholder would have. So I'll stop talking at the moment and just open that up for a few questions and just see if there's anything people would like me to go into in a bit more detail.
So Jason, there's just a question in the chat. If you could further expand a little on what you mean by redeemable.
Redeemable is a share that is written into its issue that in 2 years, 3 years, 5 years, or at any juncture, it could be redeemable at call. The existing shareholders can give a notice to the holder of the redeemable shares to say, per that underlying agreement, we would now like to redeem the shares at the value that was agreed. So it might be that you get finance from somebody on a redeemable preference share basis. They invest $100,000 with an interest payment of, say, 6% or 10% or whatever it is. But built into that is that the existing shareholders can buy those shares back in 5 years' time for $1 or some other set amount. So it just locks in a future sale. there any other
Hopefully
questions arising?
Hopefully that assists with redeemable. But any other questions from anyone?
Okay, so we start off with equity in its purest form, ordinary shares. There are, as I said, and per the slide, you can look at the timing of when capital is contributed with partly paids. You can change the character of the capital you're seeking and the terms upon which you negotiate that capital, the interest, the term, and so forth, by using something like a preference share. And there's many options in that regard. We then move into moving along this spectrum. As I said at the start, there's a continuum between equity and purely debt. Actually, there is one more thing I'd like to touch on. I've completely forgotten a slide here I thought was relevant. Before moving on from equity, the key thing that I would always advise if you are bringing in any other equity participant in your business is to, whilst that is all fresh and you're on good terms, you've negotiated the deal, it's imperative to have a shareholders agreement. That is a separate document, so this is not in the constitution or the memorandum and articles of the company. It's a separate document, and I've just put some headings there that I think are very relevant for that discussion. But you would have a discussion and try to agree on this range of things, including, well, what is the core business activity here? And that's to ensure that both parties are on the same page. You're going to go about it the same way unless there's a unanimous decision to try something different or add something in or go off on a tangent. One of the key complaints between business partners, essentially, partners is a bad word, but co-owners, is access to records, understanding what's going on in the business, budgets, cash flows, financial statements, the cash book. So you should have who's responsible, how often information is to be distributed, in what form, access to records, all of those things should be dealt with. Preemptive rights is something where you have a first right to buy out the other shareholder. Very important. So you can imagine a situation where 2 or 3 people are co-owners of a company. One decides just, no, I'm out, and sells it to a completely unrelated third party, unknown to the first 2. And you end up in business with someone that you might not have chosen to in the first place. So preemptive rights is to give those existing shareholders the first right to buy for an agreed formula or market value appraisal. Trigger events is, it's the what if. So we all hope things go well, but what if somebody suffers financial distress, bankruptcy, divorce, those sort of situations, ill health, unable to work. There needs to be a rule book on what trigger events would give rise to those preemptive rights or other actions. Who are the directors, roles, responsibilities, remuneration. One of the key fights that often happens with unrelated parties in business together is how much pay everyone's worth. Agree on how that's to be determined up front, how often you meet. Shareholder loans, if any money is advanced from any shareholders to the company, on what terms, be consistent, have an interest rate, for example. You need to agree up front what's unanimous and what's not. So decisions, so can one director decide to spend $50,000 on a new car, or does it have to be unanimous? What's your dividend policy if there's ever retained earnings and you're looking to pay a dividend? How do you determine how much to pay? And then of course, if all things go wrong, trying to avoid significant legal costs by setting out a dispute resolution program that would obviously be a path to not incurring great legal fees. So That's very much tied to equity because you would be co-owners of a business, and that's the guidance that we would normally say, get these things sorted. Does anyone have any other comments on that or questions? Okay, moving on. Sorry, I feel like I'm talking a little too much, but moving along that spectrum I mentioned before from equity to debt, it's often the case when we're talking about a fast-growing startup business that the founder is not keen to let go of a material sum of their ownership interest. It's their idea, it's their potential that they're trying to maximize and commercialize. So what ends up happening is part of the negotiation is someone who's looking at investing might want the potential upside, but also might want a little bit more security. The owner might want, as I said, to not give up too much of their equity. And so we get in between debt and equity into what we call shadow equity. And that sounds a bit odd, I realise, but essentially it's just where we're not necessarily issuing new shares, but there are funds advanced to the company, so finance is obtained, not via shares or necessarily a loan agreement, so it's not equity or debt in the purest sense, but it's by a contractual obligation or a contract wherein there's agreement that, okay, I'll advance $100,000 and my interest will be X percentage of profit, for example, or based on something other than just a flat number. It's often what we call non-contingent obligations. So that $100,000 has some debt characteristics, i.e. the person who's advanced that money, there is a non-contingent obligation to repay. So it's not like equity that now all of that is at risk and you only get it back if one day there's a return of equity or a sale. It has the character of debt in some respects, so it is an obligation to repay. If it has an equity character, these contractual shadow equity arrangements, the ATO has quite a bit of guidance on this, and typically that's where the term of these shadow equity interests might exceed 10 years. And there's various prescribed formulas on how those interests might be valued within the Tax Act. If it on balance has an equity characteristic, then any interest payments, and I use that word loosely, would not be deductible, but they potentially can be characterised as dividends and also franked. So in that scenario, even though that equity, that shadow investor does not have shares in the company, they can receive franked dividends, which might surprise you. These shadow equity interests might, on the other hand, have more of a debt character. So it is recorded as a loan. The interest may or may not reference profit or performance. It is, again, a non-contingent obligation to pay, typically an under 10-year term, and in that scenario, interest deductions can be claimed by the company. So this is a way to, if you can't raise finance or don't want to raise finance on either an equity or a debt basis, there is a lot of wiggle room between, and you have to weigh up what you're trying to achieve and how attractive it is or isn't for both you and the investor. Are there any questions regarding shadow equity? Has everyone heard of this concept? Sounds a bit foreign?
Sorry, just having trouble unmuting there, Jason. Yeah, getting a few comments in the chat that it's a little bit foreign, which is it's great to be talking about new things, understanding new ways of doing things.
Look, it's an area where you would need to, if you were exploring these sort of things, it's very important to get professional advice. These are formal contractual arrangements that should be undertaken by a lawyer, and then the tax implications of it need to be considered by a professional accountant, because the way it will be treated from a tax perspective will turn on this different characteristics and indicia of whether it's equity or debt, and that's very important to understand up front.
And there's a comment in the chat, Jason, about convertible notes.
Yeah, so convertible notes are a bit like convertible preference shares. They are often, but not necessarily always, they would normally start though as a debt instrument, and what you would normally then see is a set interest rate, a set term, and then typically a set price that at a certain time in the future for X price you can convert those notes to an equity interest or a number of shares. Now, the way those key details are encapsulated in the issue of that convertible note will determine whether it is a debt or an equity interest. But it is a sort of a form of shadow equity, but it's more like a preference share than necessarily shadow equity, because it is actually a formal instrument as opposed to a contractual arrangement. So moving through to debt, getting towards the end of that spectrum, of course, when you're raising capital in a company, there are the usual mechanisms going to the bank and seeking secured or unsecured loans, going to third-party investors and doing the same. It is clearly a recommendation, if it is not a bank, that you would formally document any loan and that's to protect both parties, agreeing on those terms up front, particularly the term of the loan, and obviously interest rate is just critical. On wind up, a loan is repaid in priority to preference and ordinary shareholders. So a loan or a debt instrument has priority in a wind up to equity. Interest is clearly the mechanism to evaluate the risk. So what you would typically see is equity is a much riskier, typically a much riskier investment. Your capital is at risk. There is uncertainty as to the sort of return you might get. And because of that additional risk and uncertainty, there is often more potential for that higher return. And you can't really escape that risk-return trade-off. The interest that you would pay on borrowing will be and is usually a reflection of that risk, and the investor in particular looking at it and you know, assessing what risk they're taking of losing their capital. As I said, documenting is the key. Two types of loans, secured and unsecured. Typically, secured loan is either a general security agreement, or if your company has an asset of some substantive value like property, it would be a specific security agreement. In those sort of scenarios, it's imperative that a lawyer is involved. Registering charges and things like that is really a lawyer's domain, and having those things done properly can make the difference. If you have an unsecured loan, then you are an unsecured creditor in the event of company failure. So again, you do rank in front of equity holders, but if there are any secured creditors, they will receive their money before you would as the investor. Are there any comments on that particular slide? Okay, well, I thought what I'd finish with is just a very rudimentary summary of debt versus equity, because the key thing here is financing and raising money for an early stage investment company. And you are on a spectrum between debt and equity, and there are trade-offs along the way. This example is one where it fundamentally depends on the performance of the underlying company and business, whether equity or debt is best. There is no escaping risk and return in these sort of scenarios. And as you can see with that example, that $100,000 company at the time of investment, lending $100,000 at 10%. 10% in this environment with interest rates seems very, very attractive. After a few years, the investor would receive $100,000 and their capital back plus 34 grand interest. But suppose for a moment that if they had taken a 50% stake in the business, which had that $100,000 value at the time, and the business a few years later is worth $500,000, then they've not increased their money by 10%, but 71% as an investor. And of course, the reverse is absolutely true for the individual who has sold down equity. So their cost of funds in that scenario, bringing that investor in as an equity participant, is up. Okay, so they're the key points I was hoping to cover. I know we've been through some questions as we've gone through individual slides, but is there anything more holistically people would like to have a quick conversation about?
Yes, Helen here. I've
Hi, Helen.
Sorry, Helen, you go, and I'll follow up on the chat after.
Yes, thank you. So I and a partner and I invested or started a startup, intellectual property, and while most of it was in their partner's domain, I invested money, and over the 2 or 3 years to get it established, and did the travelling and started sorting out websites, etc. So I guess up front I invested 30,000 of my own. I also trademarked, set up the company, trademarked it, and all that included the costs of 30. Now it's not really going anywhere, particularly with COVID. It was an education and training company, and we haven't gone anywhere at the moment. It's looking like that it most probably is best to close it down. We haven't got any returns, no financials have come in. How do I close it down, or how do we close it down? We're co-directors. I'm the company secretary, and what cost would that be?
I can only really cover that in a general sense because
No.
because without having the information at hand, specific advice would be very difficult. But
Yeah.
broadly, you can undertake a member's voluntary liquidation, which would be not very cost effective. Probably the best option would be to consider the value of those investments and whatever is on the balance sheet, and essentially write those assets down to, if you feel they're nil value, then write them down to nil value. If a company, I think the current threshold, don't quote me, but I'd have to check, but I think if the company has net assets less than $1,000, then you can go through what is a much simpler deregistration process. So you're just lodging various forms with ASIC to deregister your company.
Right.
And at that juncture, it's wound up. So that would be the simplest if you can achieve that.
Thank you. That's exactly what I need to know. Thank you, Jason.
Pleasure.
Sorry,
So-
can I ask-
Asking,
hello, do you hear me?
I might just go to a question on the chat, which is about safe agreements, and then we might come back to you.
Sure.
Jason, can you give us a quick rundown on safe agreements?
Safe agreements, as in, is that related to the previous slide on shareholder agreements, or?
Liz, did you want to elaborate a little on chat or issuing safe? Oh, sorry. Short agreement for future equity. Liz, do you want to
Short
elaborate
agreement for
on what you
future.
mean? Simple agreement for future equity. We've got a few. We've got a few comments. I'm assuming Sally and Liz are talking about a similar thing: short agreement or simple agreement for future equity, which is an idea coming out of the US. Have you heard of that, Jason?
Mm-hmm. Not the acronym itself, but it's essentially it's not unrelated to shadow equity. So you're talking about a contractual agreement that you're forming that at certain milestones and for perhaps at certain times different values, you would be eligible for the issue of further equity. So those sort of things you could spend a fair bit of time looking at and talking to, but essentially it's more often than not, traditionally they've been used as part of performance management of key staff that you would like an employee share scheme or a type of employee share scheme that that would facilitate retention of those key people. So it's just really extending that to, okay, we have some equity investors and setting out terms upon which they would be eligible to make further acquisitions in the future. So it's a type of shadow equity. It's a contractual thing.
I hope that helps to those of you that were chatting about safe agreements, and pop some more in the chat or speak up if Jason can elaborate any further. Otherwise, Arsene, did you want to go ahead with your question and we can come back to that concept if we need to?
I have two quick questions. First, if I want to raise money from overseas, how do I process them and put them in the company here?
Raising capital from overseas is not really too dissimilar to doing the same thing in Australia, excepting that you need to consider again whether it's debt, whether it's equity, and the terms upon which you're raising that money. Your Australian-based company that's set up in Australia and has an Australian resident director, and your central management and control is in Australia, will retain its Australian tax residency, so that's not an issue.
Yeah.
You really, there are some exchange rate issues there to consider in terms of the repayment of that debt, who's going to bear the exchange rate risk if it is on debt account. If it is on equity account, then the money comes in, shares are issued, it gets converted to Australian dollars for use in the company, and your foreign resident investor.
I mean, do I have to go to the lawyer and register and legalize it somehow?
Oh, I see. Look, that would depend on the situation, I'm afraid. So if in that situation, you're just issuing ordinary shares, and your accountant, who might also be your ASIC agent, and you've got an agreement with this overseas investor to issue X number of shares for X dollars. The key thing you would want to really be thinking about in that situation is this shareholders agreement. Having a lawyer go through those issues with you, making sure that all parties are on the same page up front. If the advance is in the nature of debt, again, I think a lawyer would be involved to formalise that as a loan document, and then really talk to you about the secured, unsecured, term, those sort of issues to ensure both parties are satisfied.
All right, another question, sorry about that. So there are banks, there are angel investors, private equity investors, any other types of investors that could be interested in startups?
That's a good question. All of the ones above you've already touched on. Banks don't tend to get too involved with startups, but certainly there are venture capital type people, depending on the nature of the business. Okay, that really comes down to network and contacts, but yes, there are angel investors and venture capitalists would be, and second tier lenders, but even at that second tier lending stage, they're looking for some form of security, and they are governed by the credit code and things like that. So normal commercial lending channels at the very, very early stage of a venture can be quite challenging.
All right, thank you very much. That was quite informative.
Pleasure.
Were there any other questions from anyone? Sounds like we might have, we're almost bang on time, I think. So Jason, thank you. That's fantastic. Okay. I think it seems like everyone's got a lot out of that, and it's really broken things down in an easy to understand way. So thank you very much for taking us through that and for your time.
I'm sorry I can't be there, at least on a video. My camera malfunction was rather unfortunate, but maybe next time. Yeah,
fantastic. Well, we really appreciate the time and effort that you have put into in terms of taking the time to think about what's relevant and getting that out, down onto some PowerPoint slides, and that's perfect. So thank you very much.
Thank you very much, Jason.
My pleasure. When in doubt, get some advice on these sort of matters. It's doing it up front when everyone is agreeing to terms is imperative. That's probably the key lesson from it all, I think.
I'd say so.
Excellent. All right.
Okay.
Well, thank you, everyone. We might finish it up there, and thank you all so much. And if you wanted to get in touch with Jason for any reason, then please feel free to do so through me. Is probably the best way, and we can take it from there. So wonderful. All right. Have a great afternoon.
Great.